Good afternoon, everyone. Hope you enjoyed your Memorial Day weekend festivities. This is Brian Lenz, Director of Sales here at Epic Retirement Plan Services, and I'll be your host for today's call. I'm excited to be joined by Strider Alas, a senior economist at First Trust Portfolios. I personally appreciate the candor and no pulled punches approach that the First Trust economics team consistently brings to the table. And with the wild ride we're experiencing right now, this is a very timely update. And good to note, the First Trust economics team is consistently ranked by Bloomberg, Zillow, and others as one of the top forecasters in the country. And Strider is responsible for analyzing economic indicators, writing commentary, and producing the First Trust economics blog. Beyond his research, Strider speaks regularly at events around the country and abroad, and he received his BA in Business and Economics from Wheaton College and is currently a candidate in the CFA program. As always, we will have your line muted throughout the call, but if you have any questions you want me to throw at Strider at the end here, feel free to enter those in the webinar questions panel. With that, Strider, I'll turn it over to you.
Brian, thank you so much, and good afternoon to everybody. There's obviously a lot going on. As Brian said, it's been a year filled with volatility, and I think that's going to continue here. But for me, I think really it's important to go back all the way to March and April of 2020 and think about that time when COVID was just getting started here, because I think so much of what we're dealing with today stems from that specific period, over that 2-month period when we shut down the U.S. economy. And for me, when I think about that period, I think so much of the policy decisions that were taken on over that period of time were driven out of fear rather than danger. And there's a big difference between fear and danger. Just because something's dangerous doesn't necessarily mean it's scary, and just because something's scary doesn't necessarily mean that it's dangerous. And for me, when I think about fear in itself, it's an emotion. It's the risk that we perceive. And as an emotion, it's often blind to the facts, where you think about danger is actually measurable. And so when I look back over the last 2 years and you think about all the data that we've had on COVID-19, it really hasn't changed that much from the beginning. And what we have known is that those 65 years and over are those that are most at risk from coming down with a severe case of COVID-19 and maybe even dying from it tragically. In fact, if you look at the numbers, they're only about 1.8% of our population is 85 years and over, and yet they've accounted for over a quarter of COVID-19 deaths. You look at those 65 years and over, they make up about 16.3% of our population, but they've accounted for about 75% of our deaths. And yet I think so much of the time and resources have been spent on this category from 0 to 17. And yet we've only seen about 1,000 COVID-19 deaths in that entire age group, people that have died with or from COVID-19, and yet they make up over 20% of COVID-19. And so for me, I think the issues that we're facing is because that we have taken so many resources from areas that are less scary but more dangerous, and we've shifted them to this area that's more scary but less dangerous. And this misallocation of resources is what we are dealing with today. And you think back to that March and April period, I mean, it was historic, unprecedented. We have never seen something like this before. We had 95% of U.S. population on stay-at-home orders. And again, I think this was driven out of fear more than anything else. And this caused a massive short-term recession that we went through. And not only that, when you take a look at employment, for example, we were adding jobs in that previous recovery by about 200,000 per month in and month out, all the way through February of 2020. And then as March comes around, we lost 1.4 million jobs in that single month. But that's nothing compared to April. This is the exact same chart with April on it too. And between that 2-month period, we lost 21 million jobs. You look back to 2008, 2009, the Great Recession that we went through back then, it looks like nothing compared to this 2 month period that we experienced with the shutdowns. Good news is we've added back about 21 million of these jobs, but we still have about a million jobs left just to get back to where we were in February of 2020. And so what that means is that this year we're going to continue to see strong employment reports. We think on average we'll be adding about 350,000 workers per month through this year and into next. So about 4 million or so new jobs added in 2022. And the unemployment rate's going to continue to come down, we think, to somewhere around 3.3% by the end of the year. We are not worried about a recession in 2022, and I'll get more into why we believe that. But employment's going to continue to move forward. On top of that, when you look at personal consumption, I mean, I think there's no better way to show just how dramatic what we went through was than looking at everything we spend our money on. Consumption usually just goes up and up and up. It usually falls slightly during recessions, but you take a look at that period of March and April back in 2020, it just fell off a cliff. In fact, we saw the largest drop in personal consumption that we have ever seen before in history, both as a percent and as a level. It's now back to record highs, and a lot of that has to do with the massive stimulus that was put into the economy as we've created a lot of artificial demand. But over this period of time, that March and April period, consumption fell dramatically, but at the same time, personal incomes actually rose by the most that we had ever seen in history and hit new record highs as well. And so we had record high income while we had a massive drop in consumption. And what that led to was a massive increase in the personal savings rate, how much of your monthly income, your monthly after-tax income, you're saving. In fact, it got up to about 35% and has really stayed elevated over about a 2-year period here. And a lot of that was due to the massive stimulus packages that went out. And on top of that, you think about all those people who were unemployed, about 75% of those 21 million were actually making more money being unemployed than they were being employed. And so we saw this massive increase in incomes. And so when you look at the consumer in general today, the consumer is in the best position that they have been in a very, very long period of time. One thing you probably hear is that household debt sitting at record highs and that this is going to be an imminent collapse and it's going to be just a terrible thing. I just don't buy into that, because just knowing the level of household debt, it really doesn't tell us too much. We need to compare it to something else. And usually when we're taking out debt, majority of the time we're taking out debt to purchase assets. And so household debt relative to assets is a much better effective measure to look at. And when you look at debt to assets for households, it's really sitting at the lowest levels that we have seen since the 1970s. So the consumer is in a very good position here, but this is more on a stock basis. What really matters is that flow basis. Can we continue to service all of those debt obligations that we have outstanding? And so the monthly payment really matters. And so for that, we like to look at the financial obligations ratio. And basically what this is a monthly debt obligations ratio that looks at all of your monthly debt payments as a share of your disposable income that you have to pay those payments. So it takes into account your mortgage payment, student loans, auto loans, credit cards, personal loans. It even includes rental payments if you're renting, and also property taxes if you're paying property taxes. And so this is really averaged about 16.3% going back to 1980. You can see we're well below that today. In fact, really post-COVID, or lower than anything we ever were pre-COVID. And so all this to say, the consumer in general is in one of the best positions they've been in a very, very long period of time. And we expect that to continue here moving forward. And that allows the consumer to absorb some of this higher inflation that we are currently seeing. And things are changing. We're nowhere near where we were before. Things are getting more and more back to normal. I travel all across the United States. I wouldn't say anywhere is completely back to normal, but on net, almost every day, it seems like things are getting more and more open. And that's what's going to continue to drive growth this year. We're forecasting about for real GDP to grow by about 2.5% this year. And I think a lot of that is due to the reopening that we are seeing around the country and continuing to see around the country. And for me, I think really the last area that's going to recover in the United States is that leisure and hospitality industry. If you're worried about COVID, probably the last thing you want to do is go to a hotel or fly in an airplane. And yet we have seen a dramatic comeback even here as well. Now, this is a look at TSA checkpoint travel numbers. So people going through a security checkpoint at an airport on a daily basis. That gray line there, that's 2019. That's a good base level for you to see kind of where things were pre-COVID. You look at 2020, that's that orange line. Started off the exact same, and then as March and April came around and the lockdowns took hold, travel just plummeted. In fact, it got down to about 80,000 people a day going through a TSA pre-check. I mean, think about that. In the entire United States, only 80,000 people going through a TSA pre-check a day. Rebounded by the end of the year to about 1 million, but it was really around March of 2021 when the gap between 2019 and 2021 really started to close. In fact, I think a lot of that was due to the vaccine. Whether you're for it or against it, I think it brought back a lot of confidence to U.S. citizens. And so we got to about a 20% spread between 2021 and 2019, and then we had the Delta variant, and then we had the Omicron variant, and that spread remained. But you look at where we are today, we're at a spread of about 10%. If you've flown, you know that flights are just completely packed, airports are packed, flights are expensive. All this to say, I think travel is back and back in a big way. People are more and more are moving more towards services and away from goods spending. We saw that in a lot of the retail reports that came out as a lot of companies like Walmart, Target, other companies have overstocked their shelves because they thought that there's this big movement towards goods that was going to last for forever. And now they have too much inventory, and yet the consumers moved more towards looking back towards services, eating out at restaurants again because they can, going to vacation spots and whatnot. And so all this to say, the consumer is still very, very strong. We expect that to continue moving into 2023 as well. And a lot of that is due to looking at what's gone on over the last couple of years. And not only is COVID kind of on the back burner now, I called this presentation a sea change because I think a lot of things are changing. One, COVID is kind of moving to the side. I'm not saying that COVID is dead because you take a look at the data. In fact, it's starting to ramp back up somewhere, but in some areas. But I think in general, when you look at COVID-19 and the fear that was caused by COVID-19, was a lot more extreme than the actual outcomes that we were seeing. And so now that's moved to the side, and I think that's a real benefit for the U.S. economy. But on top of that, I think a big change is in fiscal and monetary policy. We just saw a period of fiscal and monetary policy that was the most accommodative that we have really ever seen in history, and it caused everything to rise. And when you look at monetary policy in general, you think back to that period again in March and April of 2020, the Fed was able to cut interest rates to zero. They provided liquidity to basically any sector that needed it. And on top of that, they embarked on quantitative easing 4. And so if you followed us over the years, you know that we do not believe that quantitative easing really caused the markets or the economy to grow over the first 3 programs. And the reason was because that money really never saw the light of day in the economy. And so for that reason, we do not believe that it was causing stocks to rise or causing the economy to grow. How do we know that? Well, if you look at this chart here, those first 3 bumps there, the blue line, that blue line is the adjusted monetary base. That's essentially the Federal Reserve's balance sheet. You can see that first bump, quantitative easing 1, then the second bump is quantitative easing 2, and then that third bump, quantitative easing 3. Then that last bump, that big line running up there is quantitative easing 4. But if you look at those first 3 programs of quantitative easing, and then you look at that orange line, which is M2 money supply, that's money that's outstanding in our economy, what you notice is that M2 just continued to grow at the same rate that it always had grown at since 1995, which is about 6%. We really didn't see a massive increase in M2, which would have happened if that money was getting out into the economy. So why wasn't that money getting out into the economy? Well, essentially, the way quantitative easing works is that the Fed was buying up mortgage-backed securities and treasuries from banks and in turn crediting banks with reserves. Now, banks had the option. They could either lend those reserves out into the economy, which would show up in M2, or the Fed said, hey, if you want, you can hold these reserves on our balance sheet and we'll pay you interest on these excess reserves. And so what banks decided to do was hold those reserves as excess reserves on the Fed's balance sheet. Now, why did they decide to do that? Well, I think the real reason for quantitative easing, more than anything, was to shore up banks' balance sheets. If you look at cash assets as a share of total assets for commercial banks, they were down to about 3% in 2009. I mean, banks obviously were in big trouble. And what quantitative easing did essentially was it recapitalized banks' balance sheets, those first three programs. And you look at cash assets now as a share of their total assets, they're at extremely healthy levels relative to history. Well, what was so different for quantitative easing for them? Because what we have seen is a massive increase in the money supply. In fact, you look at M2 money supply, it's up more than 40% over the last 2 years. And what was different this time around is that essentially we embarked on modern monetary theory. The Fed monetized the Treasury's debt. So essentially what happened was the Treasury created a whole bunch of Treasury bills and bonds, and what they decided to do was the Fed created money out of thin air and purchased those Treasuries. Now the Treasury Department has all of this cash that was created out of thin air from the Fed, and what they did with it was they directly deposited it into people's bank accounts with stimulus payments. And so that money became new money in our system. And that caused M2 money supply, here's a closer look just at M2 money supply right here, to absolutely skyrocket, well above that 6% we have seen. In fact, as I said, more than 40% of money has been created just in the last 2 years. Pretty remarkable when you think about that. And that is what's creating the inflation that we have been seeing over the last couple of years, and we'll see probably for several more years to come. It's too much money chasing too few goods. It's really as simple as that. And we're seeing it absolutely everywhere. And yet the Fed has made every excuse imaginable except that it's a monetary phenomenon. I went back and looked at every single one of the Fed's meetings since the beginning of 2020. There's been 19 of them. And in every single meeting, I checked to see if they mentioned anything about money supply or M2. And they did not mention it once in any one of those meetings. And yet that's what they control. And it's amazing to me that they just do not believe that this is a monetary phenomenon. And it is causing big issues, this higher inflation. I mean, you look for instance, just at gasoline costs right now. Gas prices hit average gas prices hit new record highs today across the United States at $4.62 a gallon. If you think back, if you do a little kind of back of the envelope calculations here, in 2021, Americans consumed an average of 369 million gallons of gas every day. So that means that a 1 cent increase in the price of gas cost consumers an extra about $3.69 million a day, which if you look at it on a yearly basis would be about $1.347 billion a year. And so if we look over the last year with that new price that we saw today of $4.62 a gallon today, that's up 52% from a year ago, or $1.58, which means that's an added cost of $583 million per day for consumers, or $213 billion a year if prices remain here relative to what they were a year ago. That means on a household basis, on a per household basis, that'd be about an added yearly expense of about $1,637 per household. It's incredible to think about. That's for not getting anything new with your money. That's for just buying what you already were buying before, but at a much higher price. And this is just for gasoline. Think about all the food costs and everything else. Inflation is one of the worst things that can happen to an economy. And right now we are seeing high inflation. It's not hyperinflation, but it's high inflation. But I think it's important to go back and just look at how off the Federal Reserve has been, because if you go back to their December 2020 meeting, at that point, they were forecasting for the following year, so by the end of 2021, that inflation was going to be running about 1.8%. And in that meeting, they said, if anything, we think the risks are to the downside, not to the upside. Their next meeting in March, they're now up over 2%. And this is when they started to come out and talk about base effects, that last year we had COVID and so inflation was very low. So it looks high right now because we have this base effect going on. We had a very low base last year. This year it's a lot higher, and so it looks worse than it really is. We're not worried. June comes around, now they're over 3% by the end of the year. And this is when they start to talk about transitory. They start to add that to the language that this is all supply chain issues. It's just going to be temporary. Now you're in September. Now they're over 4%. They come back out and they say, look, this is just transitory. You really got to trust us here. It's just all temporary. You don't need to worry about it. Well, now by December of last year, they're over 5.2%. Well, they're still too low. They only had to forecast for 3 weeks, and it came in at 5.8%. But in this meeting here is when they finally come out and say, look, what is the definition of transitory anyway? Nobody really knows, and so we're just going to get rid of that language. And it looks like inflation's a little bit more entrenched than we originally thought. And so we're probably in 2022 going to have to raise rates instead of one time. We'll probably have to raise rates 3 times. And so even in December, which was just 5 months ago, almost 6 months ago now, they were still thinking for 2022 that inflation was going to be under 3%. Finally, by March, they start to take this seriously. They come out and they basically say, yes, inflation is here. It's more entrenched. We're going to do whatever we can do to try and lower it. We need to raise rates a lot more aggressively than we originally thought. So probably 8 times this year instead of 3 times. All this to say, it finally seems like the Fed's getting the picture that inflation is an issue. It's going to be here for quite some time, and they do need to be aggressive with rate hikes. And so we believe that their next meeting, they'll raise by another 50 basis points in June and probably another 50 basis points in July. But we wouldn't be surprised if they hold off for raising rates again until the end of the year. I think they don't want to have any major influence on the midterm elections coming up here in November, and so they'll wait till after that to raise rates again. But all this to say, rates are going to continue to go higher, and we believe that inflation is here, and it's not just transitory. 2022, the Fed, obviously, they said they're forecasting 4%. They're going to raise this again. We're forecasting about 6% for this year, 5% for 2023, and 5% for 2024. And so really, to me, I think it all comes down to a pretty simple equation. You may remember this from your money and banking classes in college, but the equation of exchange is basically, it's an identity, MV equals PQ. And what that means is basically money equals nominal GDP. And so on the left side there, you have M, which is M2, that's your money supply, times velocity, which is how fast that money's turning over in the economy, equals prices times quantity. So the Q there, that's your real GDP. P is your inflation, and they always equal. And so what we've seen over the last couple of years is we have seen a massive increase in M. Well, that's translated into a pretty large increase in quantity and a massive increase in prices. Now, quantity can only grow so quickly. It's limited by productivity and how much population and employment is growing. And so where does it come to hit the most on that other side of the equation as M continues to grow? Well, you feel it on the pricing side. And that's exactly what we have seen, and that's what we will continue to see, we believe, for the next couple of years at least, to get through the 40% increase in M2 that we have seen over the last couple of years. And yet, what's interesting to us is if you take a look at the bond market today, it seems like they're finally starting to take seriously the threat of inflation, and we started to see the 10-year Treasury finally start to move higher as the short end of the curve obviously moved a lot higher faster than the long end. Well, now we've seen the 10-year Treasury come back down to about 2.8% or so. I believe that it's going to end the year substantially higher than where it is today, at least at 3%, maybe 3.25% or so. But I think over the next couple of years, we'll continue to see it move higher and higher. And the reason I believe that is if you take a look at where we are today, the spread between inflation and the 10-year Treasury yield is the widest that we have ever seen in history. And so I believe that something has to give. Either we're wrong or those that are in the inflation camp that prices are going to be higher for longer are wrong and inflation is going to come crashing back down, or those in the bond market are wrong and the 10-year Treasury and yields in general are going to have to continue to move higher. And I liken this back to the period, it's very similar to what we saw, I think, in the 1960s and 70s, but the opposite. And what I mean by that is if you look back to the 60s and 70s, that orange line there is CPI inflation. Over the 60s and 70s, we just saw inflation take off. It just continued to grow and grow and grow. And with that, the 10-year Treasury followed suit. And it wasn't until 1980 when Paul Volcker came in and he jacked up the Fed funds rate to over 18% that it finally broke inflation's back, and inflation just came tumbling back down. But you look at the 10-year Treasury, it took a couple of years for the Treasury to finally adjust and I think to realize that this high inflation was finally over. It was finally done. And I think it took the bond market that long to realize that because they were so used to this high inflation that they had been seeing for really the past 15, 20 years in the United States. And so today, I think it's the same, but the opposite. And what I mean by that is if you look, we have seen low inflation in the United States for a long period of time. And I think that's what the bond market is so used to, that they do not believe that it's possible for us to have a sustained period of high inflation. And so I don't know when it will happen, but I think just like we saw back in the early 1980s, the Treasury market finally adjusted. I think we're going to see that adjustment happen again, but the opposite way, where we're going to see yields continue to move higher to more account for the inflation issues that we are seeing moving forward here in the coming years. But all that to say, I mean, if you look at the market today and you look at where interest rates are, I think we still have a long way to go before we're even close to a recession. Interest rates are just getting back to normal. We're moving from a Fed that's been ultra easy to now maybe just ultra easy. Eventually they'll be ultra easy and then easy, and then they'll get to a place where they're neutral before they get to tight. And we think the next recession is going to be caused by tight monetary policy. And that most likely will occur, I believe, sometime in late 2023 or early 2024. But if you look at companies today, for instance, you look at corporate cash on the balance sheet, it's sitting at record highs. Corporate profits are sitting there right at record highs as well. Companies are flush with cash and are doing very well. That's what really drives the market higher over time. And so our end of the year forecast for the S&P 500 is 4,900. That seems very aggressive from where we are today, but you see with moves like we saw last week where the market rose by over 6% just for the week, it's possible to get there a lot quicker than people could fathom. And I think so much of what we're seeing with the drop that we saw at the beginning of the year, and I don't know if it's over or not or going to continue, but to us, a lot of that is a recession being baked into the cards either today or in the near future. And we still believe it's a ways away. Higher interest rates are not going to kill the economy overnight. It's going to take a lot of time to do that. And companies are still doing exceptionally well. In fact, in the first quarter, the S&P 500 is basically fully reported now. Earnings grew 9.1% from a year ago and are still set to grow for this year by about 10%. And so for us to get back to where we were at the beginning of the year or so, or maybe a couple percent higher than where we were, we believe is not out of the question. What our models do show us today, our stock market models, we use a capitalized profits model, is that the market is as close to fair value as we have seen since really the Great Recession of 2008, 2009. So what that tells us is you need to be a lot more selective in terms of where you are looking, we think inflation-sensitive areas are where you want to be: energy, commodities, financials, materials, industrials. Those are the areas that you want to be overweight here moving forward, because again, I think inflation is going to be the biggest pressing issue for years to come. And so with that, I'll finish up there. We are still very optimistic. As you can see, we do not expect a recession. We see real growth this year around 2.5%, inflation around 6%, the 10-year Treasury by the end of the year around 3 to 3.25%. And with that, a stock market that is going to continue to move higher from where we are today. And we think the S&P, our end of the year target's now 4,900. So I'll end there. And Brian, if there's any questions, happy to take any.
Yeah, thank you very much, Strider. We'll open up to a few minutes of questions here. If you have those, please enter them in the questions panel. And while you do that, Strider, you mentioned a couple of sectors or areas that might make sense in this current environment. Are there any that First Trust, based on your analysis, would kind of suggest staying away from at this time, given the environment?
Yeah, I think anything defensive right now, which has done well, obviously, as things has come down tremendously. But I think moving forward here, the fact that we are not headed for a recession in the United States, or we do not believe that we're headed for a recession, we think cyclical areas are going to do very well. Defensive areas are going to be the areas that you want to stay away from moving forward. I think utilities are going to have a harder time over the next couple of years here. But yeah, I would focus more on cyclical areas as areas that you want to stick with.
All right, good stuff. Well, I didn't have anything else come in for us, Strider, but appreciate the time on your end, and thanks again to First Trust, our longtime partners. And thank you all for joining us for this Epic Insight webinar. We will share a copy of a recording as well as the slides should you like to revisit anything on your own time. And as always, we wish you safety and health as you support your families, colleagues, and clients. Please don't hesitate to reach out to us at Epic if there's anything we can do to help support you. Thanks again. Take care. Have a great week, all.
Thank you, Brian. Take care.